You want to know the real secret? It's not about the money. Never was. When I walked onto the floor of that Boston bucket shop with pocket change and walked out with enough to make grown men weep, I wasn't thinking about becoming rich. I was thinking about being right. And that difference, that single shift in perspective, is what separates the men who build fortunes from the boys who lose their shirts. Listen to me carefully. I've made millions, and I've lost millions. I've owned mansions, and I've slept in rooms where the wallpaper was peeling off like dead skin. I've had my name whispered with reverence on Wall Street, and I've had it spat out like poison. And through it all, through every dollar gained and every dollar lost, I learned something that most traders never figure out. Your capital isn't what's in your pocket. Your real capital is what's between your ears. They call me the boy plunger. They say I broke the market in 1929. They tell stories about me like I'm some kind of wizard who could see the future. But I'm going to tell you something nobody else will. I was just a kid from Massachusetts who learned to read the tape, and more importantly, I learned to read myself. The market didn't make me rich. Understanding my own mind did. You're sitting there right now with small capital. Maybe it's $500, maybe it's $5,000. You're looking at these numbers in your account and you're thinking it's not enough. You're watching other traders throw around big positions and you feel left behind. You're wondering if you missed your chance, if the game is rigged against the little guy. I've been there. I started with nothing. Less than nothing, actually. I started with the burning certainty that I could figure out what others couldn't. Here's what I learned early, and it saved me more times than I can count. The size of your capital matters far less than the size of your patience. When I was 14 years old, posting stock quotes at Payne Weber, I noticed patterns. Not complicated patterns. Simple ones. Prices moved in waves, in rhythms. While the big shots were busy trying to impress each other with their theories and their insider information, I was watching the numbers tell their story. The market was speaking. I just had to learn its language. Your first mistake, the one that will kill you faster than any market crash, is thinking you need to trade every day. You don't. I've gone months without placing a single trade. Months. Because I was waiting. Waiting for what? For the market to reach a point where the odds were so heavily in my favor that not betting would have been foolish. Most traders lose money not because they make bad trades, but because they make trades when they shouldn't be trading at all. Small capital requires surgical precision. You can't afford to be wrong. Well, let me correct that you can't afford to be wrong often, and you definitely can't afford to be wrong big. When you have limited funds, every dollar is a soldier in your army. You don't send your soldiers into battle unless you've scouted the terrain, studied the enemy, and waited for the right moment to strike. Anything else is just gambling, and gamblers always lose in the end. I remember this one time, I must have been 16 or 17, working at this bucket shop in Boston. I'd been watching this stock, observing its behavior for weeks. It had a pattern, clear as day. It would rally, pull back to a certain level, then rally again. The other traders in the room, they'd jump in and out like nervous cats, making a dollar here, losing a dollar there. But I waited. I watched that stock go through its cycle 3 times before I placed my bet. When I finally did, I went in heavy. Not reckless, but heavy. I knew. And when I'm right, and I know I'm right, timidity is expensive. That trade made me more money than I'd ever seen. But the profit wasn't the real win. The real win was the confirmation that my method worked. That patience, observation, and timing could overcome any disadvantage in capital size. The men trading against me had more money, more experience, more connections. But I had something they didn't: discipline and a system. Your system doesn't need to be complicated. In fact, the simpler it is, the better. Mine was built on a few core principles that I discovered by watching the market day after day, year after year. Prices move in trends. Trends persist longer than you think they will. And when a trend is about to reverse, the market gives you signals. Not mysterious signals that require a doctorate to understand. Clear signals. You just have to train yourself to see them and, more importantly, to act on them without emotion clouding your judgment. Emotion. Let's talk about that demon right now. Emotion is the killer of capital. Fear and greed. They're not just words some professor wrote in a textbook. They're living, breathing forces inside you that will destroy everything you've built if you let them. When I lost my first fortune, it wasn't because my system failed. It was because I failed my system. I got confident, started thinking I couldn't lose. The market has a beautiful way of humbling men who think they've got it figured out. I learned that lesson the hard way, but I learned it deep. Growing small capital isn't about home runs. Not at first. It's about consistent, intelligent execution. It's about taking the trades that meet your criteria and passing on everything else. It's about managing your risk so precisely that even when you're wrong, you live to trade another day. I had a rule. Never risk more than 10% of my capital on any single trade. Early on, I kept it even tighter. 5%, sometimes less. Because preserving capital is more important than making money. You can't make money if you're broke. If there's one thing that separates successful traders from everyone else, it's this: knowing the difference between a hunch and a high probability setup. A hunch is what you feel when you're anxious, when you're afraid of missing out, when you see everyone else making money and you feel left behind. A high probability setup is what you see when you've done the work, studied the pattern, waited for confirmation, and the market is practically begging you to take the trade. Learn to tell the difference, and you'll save yourself years of pain and thousands of dollars in losses. The mental game is everything. Your psychology will determine your destiny more than any indicator, any news event, any tip from a friend. I've seen men with perfect systems destroy themselves because they couldn't handle the emotional pressure. I've seen others with mediocre systems build fortunes because they had iron discipline. The market doesn't care about your feelings. It doesn't care if you need the money, if you're desperate, if you're trying to prove something to someone. It just moves according to its nature. Your job is to align yourself with that movement, not fight against it. When you're working with small capital, you have one massive advantage that wealthy traders often lose. You're hungry. You're motivated. You're willing to do the work that others won't do. Use that. Study the market like your life depends on it, because in a way, it does. Your financial life, your future, your freedom, it's all tied to how well you master this game. Not the market game, but the mental game. The game of controlling yourself, of making rational decisions under pressure, of sticking to your system even when doubt whispers in your ear. Before we continue deeper into this blueprint, I want you to do something. Drop a comment below telling me where you are right now in your trading journey. Are you just starting? Have you blown up an account before? Are you struggling with discipline? Let me know. And if you haven't already, check out our other videos on this channel. We're building something here, a community of traders who understand that success isn't about luck or secrets, it's about method and mindset. Now, let me tell you about the time I learned the most expensive lesson of my life. I'd built my capital up to a respectable sum, enough that I was starting to feel invincible. That's when the market taught me what humility really means. I got caught in a bear trap that cost me everything. Not just my money, my confidence, my reputation, my sense of who I was. I had to borrow money just to eat. The great Jesse Livermore, broke and broken. But here's what that experience gave me: clarity. See, when you lose everything, you're forced to examine every assumption you've ever made. You can't hide behind excuses anymore. You can't blame bad luck or market manipulation or anything else. You have to look in the mirror and admit the truth. You failed because you violated your own principles. I had gotten sloppy. I'd started taking trades based on hope instead of evidence. I'd let my position sizes grow beyond what was prudent. I'd confused a bull market with genius. The market was happy to correct my misconception. This is where most traders quit. They take a big loss, feel the pain of it, and decide trading isn't for them. They go back to their regular jobs and tell themselves they gave it a shot. But here's what they don't understand. That loss, that painful, gut-wrenching loss, is the tuition you pay for your education. The market is the most expensive school in the world, but it's also the most honest. It will teach you exactly what you need to learn if you're willing to be a student instead of a victim. When I started rebuilding from nothing, I did something different. I became obsessive about record keeping. Every trade, I wrote down not just what I bought and sold, but why. What was my reasoning? What did I expect to happen? What actually happened? How did I feel before, during, and after the trade? This practice, this simple act of documenting my decision-making process, transformed everything because patterns emerged. I could see where I was making the same mistakes repeatedly. I could see which setups actually worked and which ones I just thought worked. Your mind will lie to you. It will rewrite history to make you feel better about bad decisions or worse about missed opportunities. Writing it down keeps you honest. It creates a feedback loop that accelerates your learning exponentially. I'd look back at trades from months earlier and see mistakes I couldn't see in the moment. I'd see opportunities I'd missed because I was too focused on the wrong things. This written record became more valuable than any book, any tip, any advice anyone could give me. It was my personal trading Bible, written in my own blood, sweat, and tears. Let me explain something about position sizing that most traders get backward. They think position sizing is about how much money they want to make. Wrong. Position sizing is about how much money you're willing to lose. When I'm building a position, I already know my exit point before I enter. I know exactly where I'm wrong. And I size my position so that if I'm wrong, the loss is manageable, acceptable, something I can absorb without emotional damage. This isn't being pessimistic. This is being professional. Here's a specific technique I developed: scaling in. When I believe a major move is developing, I don't put all my capital in at once. I start with a small position, a test. If the market confirms my hypothesis by moving in my favor, I add to the position. If it goes against me, I cut the loss immediately and wait for a better opportunity. This approach does two things. It keeps my risk controlled, and it ensures I'm building positions only when I'm being proven right. The market is validating my analysis with its own movement. I'm not hoping I'm right. I'm watching the market show me I'm right. Most traders do the opposite. They take a full position immediately, then hope and pray it works out. When it goes against them, they freeze. They can't take the loss because it's too big. So they hold on, watching their capital evaporate, telling themselves stories about why the market is wrong and they're right. Let me tell you something that took me years to accept. The market is never wrong. Your opinion of what should happen is irrelevant. The only thing that matters is what is happening. Reading the tape, understanding market psychology, identifying trends. These are skills, not talents. You're not born with them. You develop them through repetition and observation. When I was young, I'd spend hours just watching prices move. Not trading, just watching. I was training my eye to see the patterns, to feel the rhythm of the market. It's like learning to play music. At first, it's just noise, but over time, you start to hear the melody, the harmony, the subtle shifts that signal something is about to change. The psychology of the crowd is predictable. Humans haven't changed. Greed, fear, hope, panic. These emotions drive market movements just as much today as they did when I was trading. The majority is almost always wrong at critical turning points. When everyone is bullish, when your shoeshine boy is giving you stock tips, when newspapers are declaring a new era of prosperity, that's when you need to be cautious. When everyone is bearish, when people are swearing off stocks forever, when fear is palpable, that's when the greatest opportunities emerge. But here's the crucial part. You can't be contrarian just for the sake of being contrarian. You can't bet against the crowd simply because they're the crowd. You have to wait for the market to confirm that the turn is happening. I've seen too many traders go broke trying to catch exact tops and bottoms. They're right about the direction but wrong about the timing. And in trading, timing is everything. Being right too early is the same as being wrong. Let me give you a concrete example of how this thinking applies to small capital. Say you've got $2,000. You identify a setup that meets all your criteria. You determine your risk on the trade is $100. That's 5% of your capital. Reasonable and manageable. You enter your position with your stop loss clearly defined. Now here's where most traders with small capital make their fatal mistake. They start watching that position every second. They see it go up $20 and they get excited. They see it pull back $15 and they get scared. They're on an emotional roller coaster that has nothing to do with whether their analysis is correct. What should you do instead? Once you're in a position with your stop loss set, you step away. You've done your job. You've identified the opportunity, calculated your risk, entered at the right time. Now you let the market do its job. Check it once or twice a day. No more. Your stop loss will protect you if you're wrong. If you're right, the market will move in your favor without needing your constant attention. This detachment is critical because it prevents you from making emotional decisions that override your system. The biggest breakthroughs in my trading career came not from finding better setups, but from developing better self-control. I had to learn to sit on my hands when there was nothing to do. I had to learn to take losses quickly without hesitation. I had to learn to let profits run even when every instinct screamed at me to take the money and run. These aren't natural behaviors. Your brain is wired for survival, not for trading. It wants to avoid pain and seek immediate pleasure. But trading requires you to accept small pains regularly to achieve large gains occasionally. Think about this. If you have a system that's right 60% of the time, and you manage your risk so your average winner is twice the size of your average loser, you'll be profitable. The math is simple, but executing that system requires you to be comfortable being wrong 40% of the time. Most people can't handle that. They take 3 losses in a row and they abandon their system right before the winning streak begins. Or they have a big winner and they get overconfident, increasing their risk right before a losing period. Consistency in execution is more valuable than brilliance in analysis. I'd rather have a mediocre system that I follow perfectly than a brilliant system that I follow inconsistently. Your system doesn't need to predict the future. It just needs to put the odds in your favor, and you need to execute it without deviation. Every time you override your system with a gut feeling, you're gambling. You're introducing random chance into something you've worked hard to make systematic. Here's something else nobody talks about: the relationship between time frame and temperament. Some traders are built for day trading, making quick decisions, being in and out. Others are built for swing trading, holding positions for days or weeks. Still others are built for position trading, holding for months or years. There's no right answer. What matters is matching your approach to your personality. I tried everything before I found what worked for me. I needed enough time to let positions develop, but not so much time that market conditions could change completely. Find your natural rhythm and work within it. With small capital, you need wins more frequently to maintain momentum and confidence. This doesn't mean taking low-quality setups. It means being selective for setups that have the potential to move relatively quickly. You're looking for situations where the market is coiled and ready to spring, not situations where you might be right eventually but have to wait months to see it. Opportunity cost is real. Money sitting in a stagnant position is money that can't be deployed in better opportunities. I want you to understand something about leverage and small accounts. Leverage is seductive. It promises you the ability to control large positions with small capital. And it's true. You can. But leverage is a double-edged sword that cuts deeper on one side than the other. It magnifies your losses faster than it grows your profits because of the psychological impact. A 10% loss on an unleveraged position is annoying. A 10% loss on a heavily leveraged position can wipe you out completely. Use leverage sparingly, if at all, until you've proven your system works consistently without it. The path from small capital to substantial wealth isn't a straight line. It's a series of growth spurts interrupted by drawdowns. The key is making sure the growth spurts are larger than the drawdowns and that the drawdowns never threaten your ability to continue. This is why position sizing and risk management aren't just technical considerations, they're the foundation of your survival. Master these before you worry about anything else. I'm going to tell you something that might sound strange. The money was never the point. It was just the scorecard, measuring whether I was thinking clearly or fooling myself. The market is the most honest mirror you'll ever look into. It reflects back exactly what you are, not what you pretend to be. When you're trading with small capital, you're forced to be selective and disciplined. This is a gift. Traders who start with large capital develop bad habits because they can afford to be wrong repeatedly. Then, when they face a real drawdown, they don't have the mental tools to handle it. The traders who make it share certain characteristics. They're brutally honest with themselves. They take complete responsibility. If your losses are someone else's fault, then your success is also in someone else's hands. But if you own your mistakes completely, you also own your ability to fix them. There's a moment of transformation in every trader's journey. For me, it came after I'd rebuilt my fortune for the second time. I was in a big trade that started moving against me. The old me would have held on, hoping it would turn around. But this time, I looked at the tape, saw I was wrong, and closed the position immediately. No hesitation. That's when I knew I'd finally become a real trader. I had broken the chains of hope and fear. Building wealth from small capital is a process of compound growth, both financial and psychological. Each successful trade builds your capital and confidence. Each loss handled properly builds resilience and wisdom. I made my greatest fortune after my most devastating loss because that loss taught me things success never could. Here's a truth that took me years to accept. You don't need to understand everything. Find your edge, that one or two setups you understand deeply, and exploit them relentlessly. Depth beats breadth when extracting consistent profits from the market. The mental game extends beyond controlling emotions during trades. It's about handling the inevitable ups and downs of your equity curve. Develop emotional stability that isn't dependent on recent results. Judge yourself by whether you followed your process, not by whether you made money this week. Success isn't making money. Success is having a system you trust completely and executing it without deviation. The money is just a byproduct. Focus on being a perfect executor of your system. You're at the beginning of this journey. You have small capital but unlimited potential. The blueprint I've laid out: patience, discipline, risk management, emotional control. This is what I used to build fortunes from nothing, multiple times. It works, but only if you work it. Your mind is your greatest asset and liability. The market will test you mercilessly, but if you're committed to continuous improvement, you have everything you need to succeed. Drop a comment below and tell me which part of this blueprint resonates with you most. Watch our other videos on this channel. We're building a library of knowledge that can accelerate your journey. The market is waiting for you. Make your next move count.